Hello guys, we move on with our trading academy on topratedforexbrokers.com with one of the most interesting patterns, which is part of the Western approach of technical analysis, the head and shoulders. Everyone knows what the head and shoulders is, but few know how to master this wonderful pattern. First of all, a head and shoulders is a reversal pattern, a classic reversal pattern, which is part of technical analysis. You need a bullish trend, and then the pattern, the head and shoulders, let's take a shape from here, and then the pattern, and then the market will simply reverse after the head and shoulders. So, a bullish trend, a reversal pattern, and the head and shoulders, and then a bearish trend. A head and shoulders does not always appear at the end of a bullish trend. It can form at the end of a bearish trend. For example, you have a bearish trend like this one, the market forms an inverse head and shoulders pattern, and then it moves to the upside. Before anything, let me show it to you here. How a head and shoulders looks like in textbook materials and not in the Forex market. So, we have a bullish trend. Then a bit of a consolidation starts. Let me put this one here. And then the market hesitates and then it consolidates for a while. Now it depends on the time frame. The bigger the time frame, the more powerful the implications are. A bit of a consolidation here. It could form on the horizontal. In textbook materials, you may find this on the horizontal, but it's not mandatory. And then at this moment, as technical traders, we don't know how the market will form here. But the next move you will see is a high spike, an aggressive high spike destined to stop everyone on the short side. However, only a few moments later or a few candles later, the market retraces all the way down to the original consolidation level and it forms another consolidation. At this very moment, when we see a spike like this, followed by a quick retracement, we know that the market forms a head and shoulders, and traders will focus on this consolidation on the right side. As you probably have an idea, or even if you don't, then the head and shoulders pattern, or its shape, comes from the human body. There is the head, and there is the two shoulders. The head is made up of these two spikes. Let's make it a bit different. This is the head, and of course the two shoulders. Here is the left shoulder, and the right shoulder is this one here. Basically, the consolidation area represents the two shoulders, and the head represents a high spike and a low spike. That is the head and shoulders pattern. So how do you trade this one? It is very easy. The head and shoulders has one head, two shoulders, and a neckline. What does the neckline mean? It means the traders take a trend line, they connect the consolidation part of the two shoulders here. Let's change the size and color, and here we have the neckline. Everyone waits for the neckline to be broken here on the right. Already from here we know that we deal with a head and shoulders pattern, a reversal pattern. So we wait for it to be broken, and when the price breaks the neckline, that's it. The reversal pattern ended and the market should reverse. Now, how about the take profit? When you enter a trade, you must know your way out of it before you go in. You simply apply the measure move of the head and shoulders. The measure move goes from measuring the length from the neckline all the way to the top of the head, and we paste it from the moment that the market breaks the neckline, and there is the target for your trade. Now, before anything else, it is orientative. What does that mean? It means that it is the minimum distance for the price to travel. Being a reversal pattern, it reverses the price trend, and then a new one will start. If anything, at this very point, when the measure move is reached, as traders, we should move the stop loss and break even, or trailer stop in order to profit as much as possible from the new trend. Most of the times, although it is not mandatory, the market, after breaking the neckline, it retests the neckline and then it moves low. Some traders wait for the neckline to be mandatory, but it's not mandatory. Sometimes you end up waiting for the neckline to be retested only to see that the price has reached the take profit on the measure move. So it is a two-way street, and it is a risk that aggressive retail traders will take and a risk that conservative traders won't take. Now, this is the theory on how to trade the head and shoulders pattern. Let's see in reality how it looks though. Before going on the practical side though, the more the right shoulder resembles the left shoulder in terms of distance, the price travelled, the amplitude and so on for the time taken for the two shoulders, the more powerful the pattern. So keep that in mind when you search for these kinds of patterns. This is the US dollar and Canadian dollar on the 4-hour chart, and in January 2016, you remember when the oil price collapsed from over $100 down to $30. It triggered a move high on the US dollar, Canadian dollar. Why? Because the Canadian dollar is strongly correlated with the oil market, as the Canadian economy is an energy-driven economy, and therefore oil moves are reflected in the Canadian dollar price. But at the very top, what did the market do? It consolidated. Remember, this is a 4-hour chart. There is no way to say or no excuse that you did not see this kind of pattern, followed by a sharp move high and stopping everyone. So from 137 to 146, almost 1,000 pips, and coming back to almost the same area. This would be the left shoulder here. Another consolidation somewhere around here. Then all you have to do is take the neckline of our head and shoulder. Look how it was in theory. The neckline and the head and shoulders is always presented as horizontal lines, but in reality it looks something like this. In the measuring move, what would be the measure move? We measure the length from the top of the head to the neckline, and ideally keeping a 90-degree angle in order to make it as accurate as possible. Then we project the take profit for a move like this. You may say this is okay, this is an example, but it is a perfect one from the aggressive trader, where the trader goes short from the moment that the neckline is broken. But also for the conservative broker, because if you went short here, then you had to wait for another 36, 38, 4-hour candle for the market to come into the neckline. The aggressive traders would add here as well. And then simply wait for the measure move to come. This measure move may only be orientative and it may reverse the trade. In reality, the market dipped all the way to 1.24, only to come back to the same level on the measure move. It's not like you missed something, but the idea of trading a head and shoulders pattern, the left shoulder consolidation, a high spike followed by a low spike, and another consolidation for the right shoulder, breaking the neckline and retesting it and going for the measure move. Ladies and gentlemen, this is how you trade the head and shoulders pattern. The FX market is full of them on any time frame, on any currency pair, so simply enjoy this technical pattern. Bye for now.